Welcome to the Deep Dive.
Great to be here.
So today, we're taking a closer look at an article from The Motley Fool. It just dropped yesterday, May 7th, 2025.
Okay.
And the headline, well, it definitely grabs you. This ultra-high-yield dividend stock continues to add fuel to grow its already prodigious passive income stream. The focus is on MPLX.
Right, MPLX. And the article quickly points out it's a master limited partnership, an MLP.
Okay.
So for you listening, think energy infrastructure, pipeline, storage, that sort of thing. And that headline term, ultra-high yield, they pin it at 7.7%.
Wow, 7.7. That'll make you pay attention. Especially like the article notes, when you put it next to the S&P 500's yield, which is, what, under 1.5%?
Way under, yeah.
Yeah.
A huge difference. And it's not just some temporary spike either. The article really stresses the consistency here.
How so?
Well, apparently they've bumped up their dividend payout every single year since their IPO back in 2012.
Every year since 2012.
That's what the article says. And it gets better. Since 2021, the compound annual growth rate for those distributions has been 10.7%.
Okay, 10.7% average annual increase recently. That's pretty strong growth on top of an already high yield.
Exactly. You can see why it catches the eye of income investors. That kind of reliable, growing payout is, often what they're looking for.
Right. So high yield, growing yield.
Mm-hmm.
Sounds almost too good. But the article does mention something about taxes, doesn't it? Kind of pumps the brakes a little.
It does, and it's important. Because it's an MLP, you don't get the usual 1099 DIV form at tax time. Instead, you get a Schedule K1.
K1.
Yeah. And look, it's not necessarily a deal breaker, but it can make your tax filing a bit more complicated. You might need more time, maybe even check in with a tax pro. It's just a factor you definitely need to be aware of going in.
Good point.
Yeah.
Something to factor in. So, okay, past performance looks solid, growing dividend. But what's fueling the optimism now? The article dives into their first quarter 2025 numbers, right?
Yes, it does. And the numbers are, well, pretty robust. Their adjusted EBITDA, basically, a measure of operating profit, hit nearly $1.8 billion. That's up 7% from the same time last year.
1.8 billion, 7% growth. Okay.
And maybe more importantly for dividend folks, the distributable cash flow, the DCF, that's the cash actually available to pay out, was almost $1.5 billion, up over 8% year over year.
Over 8% growth in cash available for dividends. That sounds healthy. Are they stretching to make those
It
payments?
doesn't seem like it. The article flags a distribution coverage ratio of 1.5 times.
1.5x, meaning
For every dollar they paid out in dividends, they actually generated $1.50 in distributable cash flow.
Okay, so a pretty comfortable buffer.
Yeah, a significant safety margin. It suggests the current dividend is pretty secure, and there's potentially room for more increases down the line. That's generally seen as quite strong in this sector.
So with that extra cash, what are they doing? Just hoarding it?
No, the article outlines a couple of key uses. They invested a pretty big chunk, $601 million, into growth projects just in that first quarter.
Okay, reinvesting for growth. Makes sense.
Definitely signals a focus on expansion. And on top of that, they also spent $100 million buying back their own units, which is another way to return value to the existing unit holders.
Right, buybacks can help boost the unit price. So investing in the future and returning cash now sounds positive. Did the article say anything about their overall financial health, like debt?
It did, yeah. Mentioned their leverage ratio was sitting at 3.3 times at quarter end.
3.3 times. Is that high, low?
The article frames it as comfortably below their own target ceiling of 4.0 times. So the takeaway is they're not over-leveraged, they have financial flexibility, they can likely jump on other opportunities if they pop up.
Got it. Solid financials, good recent performance. But that headline mentioned adding fuel for growth. Let's get into the future stuff. The article talks about the BangGL pipeline.
Yes, BangGL. That's a big one highlighted. MPLX is buying the remaining 55% they didn't own. It's a $715 million deal expected to close this July in 2025.
Okay, so taking full control.
Exactly. Full ownership of this natural gas liquids pipeline.
Yeah.
That probably gives them more control over operations, maybe sets them up for future expansions more easily.
Makes sense. What else is in the pipeline, so to speak? Traverse pipeline.
That's another one. They've made the final investment decision on the Traverse pipeline. It's a natural gas pipeline, and the target for it to be up and running is 2027.
2027. Okay, a bit further out. And they're upping their stake in another one, too.
Yeah, the Matterhorn Express pipeline. Also natural gas. They're investing another $151 million to increase their stake by 5%, taking their total ownership up to 10%. That deal's expected to close pretty soon in Q2 2025.
Lots of focus on natural gas infrastructure, it seems.
It definitely looks like a key area for them, and there's also a deal involving crude gathering systems.
Crude gathering. Tell me about that.
They bought some crude oil and natural gas gathering systems from a company called Whiptail Midstream. Cost was $237 million.
Okay. How does that fit strategically?
Well, the interesting angle the article points out is that this strengthens their ties with their parent company, Marathon Petroleum. It gets MPLX involved earlier in the supply chain for crude. Suggests maybe closer integration, potential synergies there.
Interesting. So acquisitions, new builds.
Yeah.
Are they expanding existing stuff too? The article seemed to list quite a bit.
Oh, yeah, a lot ongoing. They're actually expanding the capacity on that Bain-JL pipeline we just talked about that should be done in the second half of 2026.
Okay.
Then there are new natural gas processing plants. Secretariat coming online end of 2025. Harmon Creek III in the second half of 26.
Wow. Busy couple of years.
And more pipelines. Blackcomb and Rio Bravo, both natural gas, also targeting late 2026. Looking even further out, there's a partnership with Wonuk for an LPG that's liquefied petroleum gas export terminal and pipeline, aiming for 2028. Plus 2 NGL fractionators, those separate out natural gas liquids backed by Marathon, expected in 2028 and 2029. It's a really substantial backlog of projects.
That is a very long list. It really paints a picture of continuous investment. So if you kind of zoom out from all those details, the strong quarter, the acquisitions, these ongoing projects, what's the main message the article leaves you with?
I think the core message is really about visibility. Because they have all these specific projects lined up with target dates, the article argues there's pretty clear visibility into how their cash flows could grow, potentially right through the end of the decade.
Right. You can sort of see the path forward.
Exactly. And you combine that growth outlook with their current financial strength. While the article positions MPLX as being really well set to keep growing earnings, growing cash flow, and crucially, for income investors, likely growing that dividend payment.
So boiling it down, the argument is high yield now, track record of growth, solid financials, and a clear plan to keep growing. That's why the article sees it as attractive for passive income seekers.
That's the gist of it, yeah. That combination leads the article to call MPLX a, quote, rock-solid option for passive income.
Okay. So let's just quickly recap this deep dive into the Motley Fool piece. We've got MPLX offering a quite attractive 7.7% yield. They've consistently raised that payout since 2012 with strong recent growth. Their first quarter financials looked healthy, good coverage ratio, manageable debt.
Right.
And they have this whole slate of acquisitions and projects designed to fuel future cash flow growth, potentially supporting more dividend hikes down the road.
That sums it up well. The picture painted is of a company not just resting on its current high yield, but actively building the infrastructure to sustain and grow it.
It certainly helps you understand the argument the article is making. Now, of course, we always say this, but it bears repeating. This deep dive gives you the article's perspective, but any investment decision is deeply personal.
Absolutely.
You've got to consider your own financial picture, your tolerance for risk, your specific goals, and like we touched on, the whole MLP structure and those K-1 tax forms are things you really need to get your head around.
For sure. Always do your own homework. Understand the business, the risks. Don't just chase the yield number, especially with something like an MLP.
Definitely. So with all that in mind, thinking about these big multi-year projects MPLX has lined up, here's a final thought to maybe chew on. As these projects come online later this decade, and as the whole energy world keeps shifting, what sort of new opportunities or maybe unexpected challenges might pop up for MPLX beyond 2030? Something to consider.
Good question to ponder.
All right. Thanks for joining us for this deep dive.